Very good day, my dear students. If you are preparing for the CA Intermediate Taxation paper, then this video is going to be extremely useful for you. In this video, we are going to cover the Facts and Figures compiler. Facts and Figures compiler. As you know, there is a document called as Tax Cruiser, and Tax Cruiser has two compilers. One is the interlinking compiler, which is very useful, and the other is the Facts and Figures compiler. In this video, we are going to cover this compiler for income tax. There is another video for GST, and the link you will find in the description box. This compiler will help you to quickly revise important formulae, limits, thresholds, dates, etc. So why Facts and Figures compiler, sir? So we need to understand that tax law is vast, and it has numerous formulae, limits, thresholds, dates, etc. And therefore, it is challenging to remember these facts and figures, and all the more difficult to recollect them correctly while solving questions in the exam. And if you are unable to do it, inability to do so is one of the top reasons why many students fail to clear the tax exam, because they apply an incorrect formula or a different limit or an incorrect threshold, date, etc. and ultimately their answer goes wrong. So how does Facts and Figures compiler help? It highlights important formulae, limits, thresholds, dates, etc. in a super compact and easy to revise format. So this ensures what? That you solve questions in the exam without any omissions and mistakes. You don't lose out on any marks. Now there are two places where this compiler is available. One is in print form and the other is in the form of an ebook. In the printed form, you will find it printed at the end of the tax book plus concepts for both income tax and the GST. In income tax book, you will find the income tax compiler, and in the GST book, you will find the GST compiler. As an ebook, it's available on my websites. You just need to go to www.taxwithsharad.com. If you are already registered, just log in and you will find the Tax Cruiser section there where you will find this compiler. If you are not already registered, then just sign up. It's completely free, and then you access this compiler. Ebook is completely free. Now, how to use the Facts and Figures compiler for maximum benefit? Read the compiler once every fortnight. Okay. Closer to the exams, increase the frequency to once a week. This is the minimum. The more you do, the better it becomes. This compiler can be read on a standalone basis. However, for best results, I will recommend that you read it along with the tax book plus concepts. Now, each reading of the compiler, so when you read it every time, it will work like a super revision for you, and various facts and figures will get ingrained in your mind. So when you solve the questions and exams, the facts and figures will easily spring to your mind and you won't make any error or omission. Now in this compiler, content is covered to the extent relevant for CA intermediate exam. And the objective is to briefly highlight the provisions. So details are not given of the provisions, only brief highlights are given. For details, you should refer to the chapter of your study material and the relevant legal provisions. So let's begin with this video. So as you can see, this is the index of the compiler for income tax, and the compiler is arranged chapter wise, and 14 in all. So chapter wise, the facts and figures have been arranged in this compiler. So we first begin with the rates of tax. Rates of tax. Who is a senior citizen? The age should be 60 years or more but less than 80 years, and the cutoff date of birth for the previous year 23-24 is on or before 1st April 1964. Super senior citizen, age should be 80 years or more, and the cutoff date of birth for previous year 23-24 is on or before 1st April 1944. What is the basic exemption limit for default tax regime? It is 3 lakh. For optional tax regime, for a normal case, it is 2,50,000. Senior citizen 3 lakh, super senior citizen 5 lakh, and health and education cess in all the cases is 4%. Rates of tax for individual HUF, AOP, BOI or AJP, artificial juridical person. Let's look at default tax regime first. For total income up to rupees 3 lakh, there is no tax. More than 3 lakh and up to 6 lakh, the formula is 5% into within bracket total income minus 3 lakh. More than 6 lakh and up to 9 lakh, the formula is 15,000 plus 10% into within bracket total income minus 6 lakh. More than 9 lakh and up to 12 lakh, the formula is 45,000 plus 15% into within bracket total income minus 9 lakh. More than 12 lakh and up to 15 lakh, formula is 90,000 plus 20% into within bracket total income minus 12 lakh. More than 15 lakh, the formula is 1,50,000 plus 30% into within bracket total income minus 15 lakh. Now look at optional tax regime, total income. For a normal case, up to 2.5 lakh, no tax. More than 2.5 lakh and up to 5 lakh. The formula is 5% into within bracket total income minus 2.5 lakh. More than 5 lakh and up to 10 lakh, formula is 12,500 plus 20% into within bracket total income minus 5 lakh. More than 10 lakh, the formula is 1 lakh 12,500 plus 30% into within bracket total income minus 10 lakh. In the case of a senior citizen, up to 3 lakh, there is no tax. More than 3 lakh and up to 5 lakh, the formula is 5% into within bracket total income minus 3 lakh. More than 5 lakh and up to 10 lakh, formula is 10,000 plus 20% into within bracket total income minus 5 lakh. More than 10 lakh, the formula is 1 lakh 10,000 plus 30% into within bracket total income minus 10 lakh. Super senior citizen, up to 5 lakh, there is no tax. More than 5 lakh and up to 10 lakh, formula is 20% into within bracket total income minus 5 lakh. More than 10 lakh, the formula is 1 lakh plus 30% into within bracket total income minus 10 lakh. Now look at surcharge. For tax on dividend and capital gain under section 111A, 112 or 112A, the limit of surcharge is 15%. Surcharge cannot exceed this rate. This is the table for figuring out the rate of surcharge. Special income plus other income is equal to total income. What is the special income? Special income is this dividend 111A, 112 and 112A. Okay. And here is the rate of surcharge on tax on special income and surcharge on tax on other income. And then there is the formula for determining the extent of marginal relief, MR. If total income is up to 50 lakh, there is no surcharge. If total income is more than 50 lakh and up to 1 crore, the rate of surcharge is 10%. And the marginal relief formula is tax on 50 lakh plus within bracket total income minus 50 lakh. If the total income is more than 1 crore and up to 2 crore, the rate of surcharge is 15%, and the formula for marginal relief is tax plus surcharge on 1 crore plus within bracket total income minus 1 crore. Where the total income is more than 2 crore and the other income is up to 2 crore, then the rate of surcharge is the same as previous of 15%. And since the rate of surcharge remains the same, the formula for marginal relief is not actually very relevant. Marginal relief only becomes relevant when the rate of surcharge changes, it increases, and at that point, for a certain range of income, we need to determine whether marginal relief is available or not. Where the total income is more than 2 crore and the other income is more than 2 crore and up to 5 crore, then while the rate of surcharge on tax on special income remains at 15% because that is the limit, the surcharge on tax on other income increases to 25%, and therefore the formula for marginal relief is tax plus surcharge on 2 crore plus within bracket total income minus 2 crore. Where the total income is more than 5 crore and the other income is more than 5 crore, then the rate of surcharge on tax on special income remains at 15%. The rate of surcharge on tax on other income also remains at 25% in case of default tax regime. But for optional tax regime, it increases to 37%. And therefore, only for optional tax regime, marginal relief becomes relevant. And the formula is tax plus surcharge on 5 crore plus within bracket total income minus 5 crore. Rebate under section 87A is available to an individual who is a resident in India. For default tax regime, what is the eligibility? Total income is not more than 7 lakh. The rebate is equal to lower of tax on total income or rupees 25,000. Where total income is more than 7 lakh, then marginal rebate is available. And the formula for that is tax on total income minus within bracket total income minus 7 lakh. Now this needs to be a positive figure. If it is not a positive figure, then rebate will not be available. In the case of optional tax regime, where the total income is not more than 5 lakh, rebate is lower of tax on total income or 12,500. Where the total income is more than 5 lakh, rebate is not available. Rates for others, that means other than individual HUF, AOP, BOI or AJP. In the case of cooperative society, where total income is up to 10,000, it is 10%. Total income is more than 10,000, up to 20,000, it is 20%. And total income is more than 20,000, it is 30%. For firm and local authority, flat 30% rate. In the case of a company, where it is a domestic company, where turnover or gross receipt in previous year 21-22 is not more than 400 crore, rate is 25%. For others, the rate is 30%. In case of company which is not a domestic company, in the case of royalty or FTS, it is 50%, and on the balance total income, it is 40%. Plus, you need to add surcharge, give marginal relief if any, and cess applies at the rate of 4%. Special rates of tax are applicable in certain cases. For STCG under section 111A, it is 15%, LTCG under section 112A, which is exceeding the threshold of 1 lakh, it is 10%, and for LTCG under section 112, it is 20%. For winnings, say on lottery, crossword puzzles, etc., it is 30%, and winnings from online games, it is again 30%, and the rate of surcharge in all these cases is what we discussed some time back. On undisclosed income, for example, on section 69A, B, C, D, so on, the rate is 60% and the rate of surcharge is 25%. And in case of buyback tax, the rate on distributed income will be 20% and the rate of surcharge will be 20%. In all these cases, cess is applicable, leviable at the rate of 4%. We will now look at the residential status and scope of total income. First, we look at residential status of an individual. Now, there are special rules and there are general rules. In the case of special rules, where the rule is ship crew rule, employment rule, or visit rule, the individual becomes a resident if he is in India for 182 days or more. And if resident, then we need to decide whether the person is RNOR or ROR. The person is RNOR when he is non-resident in 9 out of 10 preceding previous years or is in India for 729 days or less in the preceding 7 previous years. The person becomes ROR when none of the above condition is satisfied. Where the special rule is the visit and income rule, then the person becomes a resident when he is in India for 120 days or more and less than 182 days and is in India for 365 days or more in the preceding 4 previous years. In that case, the person is straight away categorized as RNOR. Now we look at the general rule. And the general rule can be 182-day rule or 60-day rule. The person becomes a resident under these rules, under the 182-day rule, when he is in India for 182 days or more in India. Under the 60-day rule, person becomes a resident when he is in India for 60 days or more and is in India for 365 days or more in the preceding 4 previous years. Now, under these 182-day rule or 60-day rule, once the person becomes a resident, the person can now become a RNOR or ROR. The person becomes an RNOR when the person is non-resident in 9 out of 10 preceding previous years or is in India for 729 days or less in the preceding 7 previous years, and the person becomes a ROR when none of the above condition is satisfied. Now, there is this concept of total income other than income from foreign sources for various rules, and this is the threshold which we need to consider. Under the visit rule, the threshold is up to 15 lakh. Visit and income rule to apply, the threshold is more than 50 lakh. And stateless rule to apply, the threshold is more than 15 lakh. Residential status of an HUF. The HUF is RNOR when the Karta of HUF is non-resident in 9 out of 10 preceding previous years or is in India for 729 days or less in the preceding 7 previous years. And if none of the above condition is satisfied, the HUF becomes a ROR. Residential status of a company. A foreign company is a resident when its place of effective management is in India and turnover or gross receipts is more than 50 crore. We now look at exempt incomes. First, we look at agricultural income. Now, where the agricultural income is a composite income, that means it comprises components of agricultural income as well as business income, then it needs to be apportioned. Agricultural income will be exempt and business income will be taxable. For apportionment, there are general rules and special rules. In the general rule, how we compute agricultural income, market value or sale proceeds of agricultural produce used as raw material. So market value or sale proceeds of agricultural produce used as raw material minus cultivation expenses. How we compute business income? Sales minus this market value or sales receipts of agricultural produce used as raw material minus manufacturing expenses. In the case of special rules, we apply a particular ratio. For rubber, business income to agricultural income is 35 to 65. For coffee, which is grown and cured, business income to agricultural income is 25 to 75. For coffee, which is grown, cured, roasted, and grounded, business income to agricultural income is 40-60. For tea, business income is to agricultural income is 40-60. Now, partial integration of agricultural income. So, agricultural income is there is partial integration only for the limited purpose of computing tax. And for that, the condition is net agricultural income should be more than 5,000 and total income should be more than the basic exemption limit. And how do we compute tax? The formula is we compute tax on net agricultural income plus total income. Okay. And we compute tax on net agricultural income plus basic exemption limit. And the difference is basically the tax. Deduction under section 10AA in case of SEZ units. Period to begin operations in SEZ. It is 1st April 2005 to 31st March 2020. This 31st March 2020 is extended to 31st March 2021 if the letter of approval has been issued by 31st March 2020. Used plant and machinery should not exceed 20%. If it is so, then 10AA will not be available. What is the quantum of deduction? It is from the year in which the operations begin. For the first 5 years, it is 100% of profit derived from export, PDE. Next 5 years, 50% of PDE. And then subsequent 5 years, it is lower of 50% of PDE or credit to Special Economic Zone RRA account. Profit derived from export is profits into export turnover divided by total turnover, and all the figures should be for the SEZ unit. The period to utilize SEZ RRA account balance is 3 years. And there is a limit by when one can repatriate the export proceeds, and there's a 6 months from the end of the relevant previous year. Now look at some other exemptions. There is the short stay exemptions under section 10(6)(6), and under this exemption, stay in India should be 90 days or less. Now under section 10(10)(d), life insurance proceeds are exempt, but receipts from an excess premium life insurance policy is taxable except in the case of death. Now, when is this taxable? It is taxable when the premium is more than a particular percentage of the sum assured. Now, if the policy has been issued between 1st April 2003 to 31st March 2012, policy is taxable when premium is more than 20% of sum assured. Where the policy is issued within financial year 12-13, the percentage becomes 10%. Where the policy is issued on or after 1st April 2013 and the insured is disabled, the percentage is 15%. And in the case of others, the percentage is 10%. Where the policy is issued on or after 1st April 2023 and the premium is more than 5 lakh, in that case also the policy becomes an excess premium life insurance policy and is taxable. We will now look at salaries. And EE stands for employee and ER stands for employer. And we will look at various themes, theme by theme. DNS and compensatory. Underground allowance is exempt at 800 per month. Tribal areas, schedule areas, agency areas allowance is exempt at 200 per month. Retirement benefits. Gratuity exemption is available for non-government employee, and the formula depends on whether the employee is covered under the Payment of Gratuity Act or not covered under the Payment of Gratuity Act. So in case of POGA, the exemption formula is lower of A, gratuity received, B, 20 lakh, C, 15 days salary for each year of service. And for this, salary means salary into 15 by 26. And when we compute each year of service, then period more than 6 months is constituted as 1 year. In the case of non-POGA cases, the formula is lower of A, gratuity received, B, 20 lakh, C, half month salary for each year of service. And for this purpose, what is salary? Salary is half of average salary of 10 preceding months. And each year of service, completed years are taken. Pension, which is commuted, exemption is available for non-government employee, and the formula depends on whether the gratuity has been received or has not been received. Where gratuity has been received, the formula is 1/3 into within bracket commuted pension received divided by commutation percentage into 100. Where gratuity is not received, this 1/3 becomes half, the rest of the formula remains the same. Leave encashment exemption is available for non-government employee, and the formula is lower of amount received, or 20 lakh, or 10 months into average salary, or leave credit in months multiplied by average salary. Now, how do you compute leave credit in months? It is entitlement, leave entitlement, minus leave availed, minus leave lapsed, minus leave and cash, and you divide it by 30 days. Now, entitlement is maximum of 30 days for each completed year. It cannot exceed this limit. Now we look at Provident Fund. RPF, Recognized Provident Fund. Employer's contribution is exempt up to 12% of salary. Interest is exempt up to 9.5%. And accumulated balance is exempt if continuous service is there for 5 years or more. In the case of Recognized Provident Fund and Statutory Provident Fund, what about interest on employee contribution? Interest on employees' contribution. So interest on contribution greater than a particular amount from previous year 21-22 onwards is taxable. And what is this X? What is this particular amount? It is 2.5 lakh if both employee and employer contribute. However, it is 5 lakh if employer doesn't contribute, only the employee contributes. Now, employer's contribution to RPF plus ASF plus NPS, the combined contribution. Recognized Provident Fund, Approved Superannuation Fund, and National Pension Scheme. Contribution in excess of 7.5 lakh becomes taxable. And the taxable accretion on this excess, the formula is basically this. You need to compute PC divided by 2, then PC1 plus TP1, find out the aggregate, and then you multiply it by R. Now this computation needs to be made for 2 time periods. The first is from the previous year 2021 to previous year preceding the current previous year. And the second duration of time period is for the current previous year. Now, for the first one, from previous year 2021 to previous year preceding the current previous year, what is relevant is this aspect of the formula. And here PC1 stands for what? Aggregate of taxable employers' contribution to RPF, ASF plus NPS, that is more than 7.5 lakh. What is TP1? TP1 is aggregate of taxable accretion for each previous year, which is computed as per this rule. Okay. Now, second time period is for the current previous year, and here this becomes relevant. So, what is PC? PC is taxable employers' contribution to RPF, ASF plus NPS, that is in excess of 7.5 lakh. And what is R? R is basically the rate of interest. And how do we compute it? First, we find out income accrued in the fund or scheme, we divide it by the average balance. What is the average balance? It is balance on 1st April plus balance on 31st March, and we divide that by 2. VRS compensation exemption is lower of amount received or 5 lakh or 3 months salary into completed years, or salary on the retirement into months left. Retrenchment compensation exemption, the formula is lower of amount received or 5 lakh or 15 by 26 into last 3 months average pay into completed years, and for this more than 6 months is constituted as 1 year. We now come to health and life. Travel for medical treatment abroad. The expenditure is exempt. It is not treated as perquisite if the gross total income before including travel expenditure is up to 2 lakh. That is not more than 2 lakh. COVID related expenditure. This is exempt if the illness is within 6 months of diagnosis. Housing. HRA exemption formula. Lower of HRA received or rent paid minus 10% of salary or 40% of salary. This 40% is 50% for Mumbai, Kolkata, Delhi and Chennai. Residential accommodation. What is the valuation formula? In case of government employer, it is license fees. In case of other employer, where it is owned by the employer, it is a percentage of salary. And what is the percentage of salary? Till 31st of August 2023, where the population is up to 10 lakh, it is 7.5%. Where the population is more than 10 lakh and up to 25 lakh, it is 10%. Where the population is more than 25 lakh, it is 15%. This has changed from 1st September 2023. Where the population is up to 15 lakh, it is 5%. Where the population is more than 15 lakh and up to 40 lakh, it is 7.5%. Where the population is more than 40 lakh, it is 10%. Where the accommodation has been leased or hired, the value is 15% of salary. This is reduced to 10% from 1st September 2023. In case of a hotel, the value is lower of charges paid to the hotel by the employer or 24% of salary. If furniture is also provided, if it is owned by the employer, then you add 10% per annum of the cost. If it is higher, then you add the higher charges. In case of gas, electricity and water valuation, if it is supplied by an agency, then the value is amount paid by the employer to the agency. If it is supplied by the employer itself, then it is manufacturing cost per unit. Travel and conveyance. Disabled conveyance allowance is exempt at 3,200 per month. Transport system allowance is exempt at 70%, subject to a maximum of 10,000 per month. Leave travel concession. How many children are covered? Maximum of 2 born after 1st October 1998. What is the block? Exemption is available up to a maximum of 2 journeys in a block, and the current block is from 2022 to 2025. Exemption is equal to lower of the amount spent or the specified amount. Motor car valuation. Where use is wholly official, the value is exempt if documentation conditions are fulfilled. Where the use is wholly personal, the value is 10% per annum of the cost. We add expenses incurred by the employer, that is higher charges, repair and maintenance, etc. Where the use is a mixed use, that means both personal and official. And if the employer owns the motor car and bears the R&M expenses, then the value is 1,800 or 2,400 per month, depending on whether the CC is up to or more than 1.6 liter, and we add 900 per month for chauffeur if provided. In case of mixed use, where the employer owns the motor car but the employee bears the R&M expenses, then the value is 600 or 900 per month based on whether the CC is up to or more than 1.6 liter, and we add 900 per month for chauffeur. Where the use is mixed use and the employee owns the motor car but the employer bears R&M expenses, then how we compute the value? We first determine the actual expenses of employer. From that, we reduce what? 1,800 or 2,400 per month, depending on whether the CC is up to or more than 1.6 liter. We further reduce 900 per month for chauffeur. Where transport facility is provided by the employer, if the employer is airline or railways, the value is exempt. In case of any other employer, the value is value at which it is offered to the public. Now we come to education. Children education allowance is exempt at 100 per month per child, maximum 2 children. Children hostel allowance is exempt at 300 per month per child, maximum 2 children. If education facility is provided to a family member, and if the institution is of the employer or the employer has a tie-up with such institution, then the value is exempt if the value per child is up to 1,000 per month. Now assets. Use of movable assets and transfer of movable assets. In case of use of movable assets, where the asset is owned by the employer, the value is 10% per annum of cost. Where hired by employer, the value is higher charges. But in case of laptop or computer, there is no value, it is exempt. In case of transfer of movable asset, the value is cost minus depreciation at X percentage for completed years of use by the employer. And what is X percentage? It is, in case of computer or electronics, it is 15% on WDV method. In case of car, it is 20% on WDV method. In case of others, it is 10% on straight line method, SLM. Office support and financial incentives. Where free food and beverages are provided in the office at working hours or via paid vouchers, exemption is to the extent of 50 per meal. The balance is taxable. If concession loan is provided, then petty loans are exempt. That means up to 20,000 in the aggregate in the financial year. And for computing the perquisite value, we adopt a benchmark rate, and that is the SBI rate as on 1st April of the previous year. In the case of ESOP, how do we value? The value is fair market value on the date of exercise of option. In case of gift voucher or token, which is in kind, it is exempt if the value is less than 5,000 in the aggregate in the previous year. Now there is this concept of specified employee, and there are certain cases where the employee is considered to be a specified employee. Now one of the cases, an employee with substantial interest in the company. And for this purpose, substantial interest means that the employee is holding 20% or more equity shares in the company employer. A specified employee also includes an employee whose salary income exclusive of non-monetary benefits is more than 50,000 rupees. Deductions under section 16 are allowed from the gross salary income. A standard deduction is allowed which is lower of 50,000 or the amount of salary. Entertainment allowance exemption is allowed but only for a government employee, and the formula is lower of 20% of basic salary, 5,000 rupees, or the allowance received. Professional tax is deductible to the extent of tax paid. We now move to income from house property. Treatment of self-occupied property or unoccupied property, SOP or UOP. Up to 2 houses is treated as SOP or UOP, and beyond 2 houses, the properties are treated as deemed to be let out property or DLOP. Expected rent, ER, is equal to higher of FR fair rent or MV municipal value, but limited to SR standard rent. AR actual rent is equal to rent for the previous year minus unrealized rent if any. GAV gross annual value is equal to higher of expected rent or actual rent. NAV net asset value is equal to GAV gross annual value minus municipal tax actually paid by the owner during the previous year. And the NAV is nil in case of SOP or UOP. Income from house property computation formula is NAV minus the standard deduction minus interest on borrowed capital. Vacancy allowance is available. If the actual rent is less than the expected rent owing to vacancy, then the gross annual value is taken to be the actual rent, not the expected rent. The standard deduction is 30% of NAV. Interest is deductible on borrowed capital, both for current year's interest and prior period interest. For LOP and DLOP, full interest is deductible. In case of SOP or UOP, there is a limit. Where it is a case of repair, renewal or reconstruction, the limit is maximum 30,000. Where it is a case of acquisition or construction, A/C, and the borrowing is before 1st April 1999, again the limit is 30,000. Where there is acquisition or construction but the borrowing is on or after 1st April 1999 and the acquisition or construction is completed within 5 years from the end of the financial year of borrowing, the limit of deduction is 2 lakh. And the overall deduction for #2, which is in the case of SOP or UOP, the overall deduction limit is 2 lakh. Now, prior period interest is allowed as deduction in the case of acquisition or construction. Prior period interest is from the date of borrowing to the 31st March preceding the date of completion of acquisition or construction. And the interest is deductible in 5 years, equal annual installments starting from the previous year of acquisition or construction. In the case of co-owners, where it is a case of SOP or UOP, each co-owner gets the benefit of nil NAV, and also the interest limit of 30,000 or 2 lakh is available to each. In the case of let out property, we first compute income from house property under that head and then we apportion it as per the share. If arrears of rent or unrealized rent is received, then it is taxable after giving a flat deduction of 30%. If the property is held as stock in trade, then the NAV is taken to be nil up to a period of 2 years from the end of the financial year in which certificate of completion has been obtained. There is this concept of deemed owner, where deemed owner, even though not the legal owner, is taxable in respect of the income from house property. And there are several situations. One of the situations is a case of lease, where the lease is for 12 years or more. The lessee is considered to be the deemed owner. Let's now look at PGBP, profits and gains of business or profession. Deductions for assets. We'll now look at depreciation. Rate of depreciation. In case of building, for residential it is 5%, for non-residential it is 10%, for temporary erections it is 40%, furniture and fixtures, it includes electrical fittings and the rate is 10%. Plant and machinery, for computers plus software and books it is 40%, for motor car it is 15%, 15% is also the general rate of depreciation. For intangible assets it is 25%. Formula for allowing depreciation is, we arrive at the opening written down value, opening WDV, as on 1st April. To that we add the actual cost of assets acquired during the previous year, and from that we reduce the monies payable for various disposals, sale, etc. and we compute this, and then we multiply it by the rate of depreciation, that is the amount of depreciation. The quantum of depreciation, where the asset is put to use for 180 days or more, full depreciation is allowed. Where it is put to use for less than 180 days in the previous year, only 50%, that is half of the eligible depreciation is allowed. Where the asset is not at all put to use, no depreciation is allowed. To check whether the asset has been put to use in the previous year 22-23 for 180 days or more, it should be put to use latest by 3rd of October 2022. How to compute actual cost? While computing actual cost, if the payment is made to a person in a day by a non-specified mode, for example cash payment, then that is excluded from actual cost if the payment is more than 10,000. Additional depreciation. The rate is 20% of actual cost of new plant and machinery. Where the asset is put to use for less than 180 days in the previous year, only half, that is 10% additional depreciation is allowed, and balance 10% is allowed in the next previous year. There is a special formula to compute actual cost in certain cases. In case of gift or inheritance, the actual cost is taken to be the actual cost to the previous owner. From that we subtract notional depreciation so far as if the asset was the only asset in the block. Okay. If there is a private building which has now been brought into the business, then how do we compute actual cost? It is actual cost of the building minus notional depreciation so far. Now we come to deduction under section 35AD. The quantum is 100% of capital expenditure incurred for specified business. Specified business, in the case of a hotel, it should be 2-star or above the rating. In case of hospital, it should be 100 beds or more. Now there is a range of dates which have been prescribed for commencement of operations of specified business who has to be eligible for 35AD deduction, and this range is from 1st April 2007 to 1st April 2017. Used plant and machinery should not be more than 20%, otherwise 35AD will not be allowed. 35AD deduction is not allowed if the payment is to a person in a day by a non-specified mode, for example cash, which is more than 10,000. There is a lock-in. For use of asset in a specified business, the lock-in is of 8 years. That means the asset should be used for 8 years in the specified business. If there is a default, then the income is taxable in the previous year of default. And the formula is deduction under section 35AD, that means 35AD is now rolled back, minus depreciation allowable in lieu thereof. That means if 35AD is rolled back, in lieu of that depreciation is allowed. So deduction under section 35AD minus depreciation allowable in lieu thereof, and the asset is then added to the block for depreciation purposes, and for that actual cost is the actual cost minus depreciation allowable since its acquisition. Now we come to amortization provisions. 35D preliminary expenses. Deduction is given of 1/5 every year for 5 previous years. The eligible expenditure quantum is lower of A, 5% of cost of project, or B, capital employed. Capital employed is relevant only for an Indian company. 35DDA VRS expenditure. Deduction is allowed of 1/5 each year for 5 previous years. 36(1)IX family planning expenditure. This is allowed only for a company SSE, 100% of revenue expenditure, and capital expenditure is 1/5 each year for 5 previous years. For a non-company SSE, revenue expenditure can be claimed as deduction in terms of section 37(1). Section 35 scientific research expenditure. Where payment is made to specified entities, 100% deduction is allowed. In case of in-house expenditure, it depends whether it is post-commencement or pre-commencement. If it is post-commencement, then 100% expenditure, whether capital or revenue, is allowed. It is not allowed in case of land. If in-house expenditure is pre-commencement, then 100% of capital expenditure, not on land, it is allowed. As far as revenue expenditure is concerned, only certified expenditure on salary and material is allowed. What is pre-commencement period? It is 3 years preceding the commencement of business. Where the asset is sold after scientific research, then deemed profit arise, and the formula is lower of sale proceeds or deduction allowed under section 35. Capital gains also arise in case of sale. Where the asset is used in business after scientific research, then it is added to the block for depreciation purposes, and the actual cost is taken to be nil, and when the asset is subsequently sold, capital gains also arise. Now we come to certain special deductions. Deduction on account of employer contribution to NPS account of the employee. So employee contribution is deductible up to a limit of 10% of salary, where salary means basic salary plus DNS allowance if terms of employment so provide, in commission if it is based on a fixed percentage of turnover. In case of bad debts recovery, if there is deficiency in recovery, then it is deductible, and the formula is we compute debt, the amount of debt minus deduction allowed under section 36(1) VII for bad debts, and then we subtract the amount of recovery, and the deficiency, whatever is there, it is allowed as a deduction. If the recovery is more, then deemed income arises, and the formula basically reverses. We compute the same amount, debt minus deduction, under section 36(1)(7), and that is subtracted from the recovery. So the excess is taxable as deemed income. When we are talking about partnership form, then remuneration to working partner is allowed as deduction, and the extent is based on the formula, as per which on first 3 lakh of book profit, what is allowed is higher of 1.5 lakh or 90% of book profit, and on the balance of book profit, 60% of the balance is allowed. We add this up, and this is what is the extent of the deduction. Interest to partner is allowed up to 12% simple interest per annum. What is book profit? It is PGBP income before deducting remuneration to partners. In a case where a stock in trade has been converted into a capital asset, on conversion business income arises, and the value is of the income is fair market value of the stock in trade, and then it is added to the block for the depreciation purpose, and the actual cost of such capital asset is taken as FMV as above. Certain disallowances, meaning expenses are not deductible. Section 40A IA is for TDS default, where the payment is to a resident payee and the extent of disallowance is 30%. Section 40A2 is for payment to related party and disallowances to the extent the payment is excessive or unreasonable, and there is a definition of related party. One of the elements is that the person becomes a related party if the assessee has substantial interest in case of a company where the assessee holds 20% or more of equity shares, in case of others where the assessee holds 20% of the profits. 40A3 is for disallowance of payment made to a person in a day by non-specified mode, for example cash, which is more than 10,000. This limit is enhanced to 35,000 in case of payment to goods carriage operator. No disallowance is made if terminal benefits are being paid where the amount is up to rupees 50,000, and no disallowance is also made where the salary is being paid in case of a temporary posting, which is for 15 days or more. Special provisions. In case of section 41(1), deemed profits are taxable on recovery which has been made against a deduction which has been allowed earlier, and the taxable amount is amount obtained or the value of benefit. Then there is section 43CA. It applies in the case of land or building, in which case stamp duty value is taken as the full value of consideration for computing business income if the stamp duty value is more than 110% of the actual consideration, where the valuation is referred to a valuation officer. Then if the value of the valuation officer is more than the SDV, then the full value of consideration is the SDV. However, if the value of valuation officer is not more than the SDV, then the full value of consideration is taken to be the value determined by the valuation officer. Compliance related provisions. 44AA, maintenance of books and documents. In the case of a specified profession, books and documents are to be kept and maintained as prescribed by Rule 6F if the gross receipt is more than 1.5 lakh in all the 3 preceding previous years. If this condition is not satisfied, only reasonable books and documents are required to be maintained, as will allow the AO to compute the income. In case of business or a non-specified profession, only reasonable books and docs as would enable the AO to compute income is required to be kept and maintained if the income of business or a profession is more than 2.5 lakh, or the sales turnover or gross receipt in business or profession is more than 25 lakh in any one of 3 preceding previous years. If this condition is not satisfied, then there is no requirement under section 44AA. Now this 2.5 lakh and 25 lakh is basically the limit for individual and HUF. For others, this 2.5 lakh becomes 1.2 lakh and 25 lakh becomes 10 lakh. In case of default for 44AA provisions, penalty for non-compliance is 25,000. Now 44AB 44AB is tax audit. In case of profession, tax audit is required if gross receipts is more than 50 lakh. In case of business, where the receipts in cash mode is not more than 5% of all receipts and payments in cash mode is not more than 5% of all payments, the limit for tax audit is 10 crore. So tax audit is required only if sales turnover or gross receipt is more than 10 crore. If the above condition is not satisfied, then this 10 crore limit becomes 1 crore. A specified date for furnishing tax audit report is by 1 month prior to the ROI due date. Penalty for default for tax audit provisions is lower of 0.5% of sales turnover or gross receipts or rupees 1.5 lakh. Now presumptive income provisions 44AD, 44ADA, 44AD, 44AD. 44AD eligibility condition is that turnover or gross receipt in business should not be more than 2 crore if cash mode receipts, for example cash, uncrossed check, etc. If cash mode receipts is more than 5% of turnover or gross receipts, this 2 crore is increased to 3 crore where cash mode receipt is up to 5% of turnover or gross receipt. Deemed profit and gains is X%. 6% of turnover or gross receipts in the previous year received by specified modes up to the ROI due date plus 8% of the other turnover or gross receipt. There is a lock-in period to remain under section 44AD, which is 6 previous years, and if there is default in remaining within this lock-in period, then SSE is out of 44AD for the previous year or of opt-out plus the next 5 previous years. 44ADA. 44AD applies where the gross receipt is not more than 50 lakh if the cash mode receipts is more than 5%. This 50 lakh is increased to 75 lakh if the cash mode receipts is up to 5% of turnover or gross receipt. Deemed profit and gains under 44ADA is 50% of gross receipts. 44AE, the SSE should not own more than 10 goods carriages. Deemed profit and gains in this case for HGV, that means heavy gross vehicle, is rupees 1000 per ton in 2 months or part of a month owned while the HGV is owned in the previous year. Deemed profit and gains for other vehicles is to the extent of rupees 7500 for every month or part of a month while such vehicle is owned in the previous year. HGV means heavy goods vehicle if the gross vehicle weight in ton is more than 12 ton. Now we look at capital gains. CA is equal to capital asset, CG is equal to capital gain. We look at some points related to chargeability. What is urban area? Now, rural agricultural land in India is not a capital asset, so capital gain does not arise. So, rural area means an area outside urban area. So, what is urban area? Where a population is more than 10,000 and up to 1 lakh. Urban area is up to 2 kilometer. Star, up to 2 kilometer. This is the aerial distance from the local limits of municipality or cantonment board. Where population is more than 1 lakh and up to 10 lakh, this is up to 6 kilometer. Where population is more than 10 lakh, this is up to 8 kilometers. Period of holding for determining whether the gain is LTCG, long-term capital gain. In case of shares listed in India, it is 12 months. Shares not listed in India, 24 months. Units of UTI or equity-oriented fund, 12 months. Units of debt-oriented fund, 36 months. Zero coupon bonds, 12 months. And other securities listed in India, 12 months. And other securities not listed in India, 36 months. Land and building, 24 months. Any other capital asset, for example, jewelry, 36 months. What is equity oriented fund? It depends. If the fund invests in another fund, then X%, 90% or more is invested in units of other fund which also invests 90% or more in equity shares of listed domestic companies. If that is not the case, then if 65% or more is invested in equity shares of listed domestic companies, the fund is equity oriented fund. STCG, how to compute? Full value of consideration minus expenditure on transfer minus cost of acquisition or cost of improvement minus exemption, if any, 54, 54, B54F, etc. LTCG, how to compute? full value of consideration minus expenditure on transfer minus indexed cost of acquisition or indexed cost of improvement minus exemption if any. Cost of acquisition, where the capital asset is acquired before 1st April 2001. COA is higher of the cost, or B, fair market value on 1st April 2001, which cannot exceed the SDV stamp duty value on this date as far as land or building is concerned. COI, cost of improvement, it excludes expenditure incurred before 1st April 2001. Index cost of acquisition. The formula is you take the cost of acquisition, then you multiply it by what? The ratio of CII, cost inflation index of financial year of transfer, divided by CII of later of financial year when asset is first held, or the base year, which is 2001, 2002. Index cost of improvement, you take cost of improvement and then you multiply it by the ratio, which is what? CII of financial year of transfer divided by CII of financial year when improvement took place. Cost inflation index, the base year is 2001-2, for which CII is 100, and for the current year 2023-24 it is 348. If there is advance money which has been forfeited, if it is forfeited before 1st April 2014, then it is deducted from the cost or WDV or FMV as the case may be in computing cost of acquisition. If the forfeiture is on or after 1st April 2014, then it is taxable under the head IFOS. Concept of previous owner. Where the asset is acquired from a previous owner in a specified mode, there are specified modes. Okay, for example, gift, will, etc. Then there is no capital gain for the previous owner. The capital gain arises in case of subsequent transfer of the asset, in which case cost of acquisition of the previous owner is taken. Period of holding includes the period of holding of the previous owner. Indexation starts from the year the asset was acquired by the previous owner. Benefit of FMV as on 1st April 2001 is available in determining cost of acquisition. Cost of improvement includes cost of improvement incurred by the previous owner. What is the cost of acquisition of the previous owner? If it is not ascertainable, in that case we take the FMV. Special provisions for depreciation for depreciable assets, section 50. Where the block of assets exists and WDV is not nil, that means it is positive, then depreciation is allowable and consequently no capital gain arises. However, where the block doesn't exist or the WDV is nil, that means not positive, then short-term capital gain arises. Short-term capital gain always. STCG formula, full value of consideration minus expenditure on transfer minus opening WDV of the block as on 1st April minus the actual cost of assets acquired in the block during the year. Benefit of FMV on 1st April 2001 is not available and indexation is not available because the gain is always short-term capital gain. Cases where capital gain is taxable other than in the previous year of transfer. Capital gain is taxable in certain cases in the case of receipt of insurance compensation, and when we compute capital gain, the full value of consideration that we take is money received plus FMV of assets received from the insurance company. Conversion of capital asset into stock in trade. Now capital gain arises on such conversion, and for computing capital gains, full value of consideration is taken as the fair market value as on the date, fair market value of capital asset on the date of conversion. Then when the stock is sold, business income arises, and while computing business income, cost is taken to be the FMV as above said. Conversion of stock in trade into capital asset. On the conversion of stock in trade into capital asset, business income arises, which is equal to the FMV on the date of such conversion. And when the capital asset is subsequently sold, capital gain arises, and then the cost of acquisition is taken to be the FMV as above said. In case of compulsory acquisition, also capital gain arises. When we are talking about initial compensation, while computing capital gain, we take full value of consideration, which is equal to the initial compensation. So FVC is equal to the initial compensation. In case of enhanced compensation, cost of acquisition and cost of improvement is taken to be zero, nil. Interest, if interest is received on account of compulsory acquisition, then it is taxable under the head income from other sources after giving a flat deduction of 50%. Special provisions exist to prevent tax avoidance. First is section 50C, which applies in the case of land or building. In that case, the stamp duty value is taken as the full value of consideration if the stamp duty value is more than 110% of the actual consideration. Where the valuation is referred to a valuation officer and it determines the value, then if the value of valuation officer is more than stamp duty value, then the FVC, full value of consideration, is taken to be the stamp duty value. However, if the value of valuation officer is not more than stamp duty value, then the value of the valuation officer is taken to be the full value of consideration. 50CA applies to transfer of unquoted shares. If actual consideration is less than fair market value, then fair market value is considered to be the full value of consideration. Now, the AO can refer valuation of a capital asset to the valuation officer if the fair market value is more than the value claimed by the SSE by more than 15%. That means if the fair market value is more than the value claimed by more than 15% or rupees 25,000. Financial assets. In the case of bonus shares, cost of acquisition is nil. Rights entitlement which is renounced, cost of acquisition is nil. Right shares which are purchased by the renouncee, the cost of acquisition to the renouncee is the price paid to the renouncer for the entitlement plus the amount which he or she has paid to the company for shares. Buyback of shares by a domestic company. In that case, buyback tax is levied, which is 20% of distributed income. To that, we add 12% surcharge. And finally, to the tax plus surcharge, we add 4% HEC. What is distributed income? It is amount paid on buyback minus the amount received on issue. ESOP. Employee stock options. In that case, in stage 1, perquisite arises on allotment taxable under the head salaries, and that is equal to the FMV on date of exercise of option. On subsequent transfer, capital gain arises, and for that, the cost of acquisition that is taken is the FMV as taken aforesaid. Market linked debentures MLD or unit of specified mutual fund SMF. Capital gain arises on transfer, redemption, or maturity. And the nature of capital gain is always short-term capital gain, which is computed as full value of consideration minus expenditure on transfer minus cost of acquisition. And specified mutual fund basically is a fund which invests not more than 35% in equity shares of domestic company. In case of intangible assets, what is cost of acquisition and what is cost of improvement? What is cost of acquisition? Category A, capital asset falling in category A. What are these capital assets? Goodwill of business or profession, trademark or brand name of business or profession, then any other intangible asset, right to manufacture, produce, process, article or thing, right to carry on business or profession, tenancy rights, stage carriage permits, loom hours, or any other right. In such case, if the capital asset has been purchased, cost of acquisition is the purchase price. If it is acquired from a previous owner, then it is the purchase price of the previous owner. If it is self-generated, then the cost of acquisition is nil. Substitution of fair market value on 1st April 2001 is not allowed while computing the cost of acquisition. Now, when we are determining cost of improvement, it depends on the capital asset. If it is a category B1 capital asset, category B1 is what? Goodwill or any other intangible asset of business, right to manufacture, produce, process, article or thing, right to carry on business or profession or any other right. In such case, irrespective of the whether it is purchased or acquired from previous owner or self-generated, cost of improvement is nil. So no deduction on account of cost of improvement is allowed. But if the capital asset is falling under category A but not under B1, that means if it is falling under category A but not under B1, then the actual cost of improvement is allowed as a deduction. What about slum sale? Full value of consideration is taken to be the fair market value of capital assets on the date of transfer. Cost of acquisition and cost of improvement is the net worth, no indexation is allowed. Period of holding for long-term capital gain is 36 months, but for LTCG, no indexation is allowed. Net worth. What is net worth? It is value of total assets minus value of liabilities as per the books. What is value of total assets? Value of assets. In case of depreciable assets, it is the WDB of the block. In case of self-generated goodwill, it is nil. Where the cost is deducted under section 35AD, it is nil. In case of other assets, it is the book value. If there is any change which has occurred due to revaluation in the value, then that is to be ignored. Now let's look at exemptions. Section 54, 54B, 54D, 54EC and 54F. A quick comparison. What is the time limit to acquire the new asset for claiming exemption? P stands for purchase and C stands for construction. For section 54, the new asset should be acquired within 1 year, should be purchased within 1 year before or within 2 years after the transfer of the capital asset, the original capital asset. Or construction of the new asset should be made within 3 years after the transfer of original asset. In case of section 54B, it is purchased within 2 years after the transfer of original asset. For 54D, it is purchase or construction within 3 years after. For 54EC, it is purchase within 6 months after. For 54F, it is purchase within 1 year before or 2 years after, or construction within 3 years after. What is the quantum of capital gain exemption? For 54, 54B and 54D, it is cost of new asset which is exempt. Cost of new asset which is exempt. For 54EC, cost of new asset is exempt, but the maximum limit is 50 lakh. For 54F, there is a formula where you apply a ratio to the amount of capital gain. So basically it is capital gain multiplied by the ratio, and the ratio is what? It is cost of new asset divided by the net consideration. Okay, so 54, 54B, 54D, it is cost of new asset. 54EC, cost of new asset with a limit of 50 lakh, and 54F is this formula where you multiply capital gain by the ratio of cost of new asset divided by net consideration. Now, for 54, for all sections except 54EC, cost of new asset is what? It is the amount which is utilized for new asset before furnishing return of income. Okay, plus deposit in the capital gain account scheme before furnishing return of income, but latest by due date to furnish return of income. So both need to be added, and that is the value of cost of new asset which is applied for granting exemption. Cost of new asset cannot exceed 10 crore under section 54 and 54F. So for 54 as well as for 54F, the limit of cost of new asset CNA is 10 crore. So there is a limit in terms of exemption. For 54EC, it is 50 lakh. For 54, cost of new asset is, the limit is 10 crore. For 54F, it is 10 crore. Now, what is the lock-in in terms of new asset? The new asset should not be transferred before the expiry of 3 years. So the lock-in is 3 years. Now this 3 years is actually 5 years for 54EC. What if the new asset is transferred within this lock-in period? For 54, 54B and 54D, the exemption which was granted earlier is forfeited, and for computing capital gain, the cost of acquisition that is taken is the cost minus the capital gain which was exempted earlier. For 54AC, what is the implication for transfer within the lock-in period? The exemption is forfeited, and for that capital gain is equal to capital gain exempted earlier. For 54F, there are two implications. Number one, capital gain arises on transfer of new asset. Number two, exemption is forfeited, and in such case capital gain is equal to capital gain exempted earlier. Now, capital gain account scheme. One should utilize the capital gain account scheme CGA as deposit within a period of 3 years. This 3 years is 2 years for 54B. Further, you need to note that CGAS is not applicable under section 54EC. Okay. In case of default, that means if the amount is not utilized for the purpose of acquiring new asset within this period, if it is not utilized at all or if it is misutilized, that means there is a default. In case of 54, 54 and 54B and 54D, capital gain arises, and that is equal to the deposit which is not utilized as per the provisions. In case of 54EC, CGAS is not applicable, so this is not relevant. In case of 54F, in case of default, capital gain arises, which is equal to the excess exemption which has been granted. Now we look at tax on capital gain. Section 111A, short-term capital gain arises, which is taxable at a concessional rate of 15%. 112A, LTCG arises, which is taxable at 10% on LTCG, which is more than 1 lakh. in case of section 1112, in case of section 112, for a non-resident, in the case of unlisted securities or shares of closely held company, the rate is 10%. In case of listed securities not being units, or in case of zero coupon bond, the rate is lower of either 20% with indexation or 10% without indexation. For any other capital asset, the general rate of 20% applies for long-term capital gain under section 112. Now there is this benefit of unexhausted basic exemption limit, which is available to a resident individual or HUF. This is called UBEL. UBEL is equal to the basic exemption limit minus the normal income. And the normal income is income other than special income or the special capital gain income or the capital gain income taxable at special rates. That is under section 111A, 112A and 112. So income other than 111A, 112A or 112 is the normal income. We reduce that from the basic exemption limit, and if the result is a positive figure, that means that is equal to UBEL. And what is the benefit that is given? Capital gain which is taxable under section 111A, 112A or 112 is equal to such capital gain minus the UBEL. So we reduce UBEL from the capital gain, and then we apply the rate of tax on such a reduced amount of capital gain. There is a special provision to compute cost of acquisition in case of shares or unit covered under section 112A LTCG. So if the shares or unit covered under section 112A is acquired before 1st February 2018, then the cost of acquisition is higher of A, the cost, or B, lower of FMV on 31st January 2018 or full value of consideration, lower of A or B. Okay. Now FMV on 31st January 2018 is computed as follows. It depends if the capital asset is listed on 31st January 2018 or not listed on 31st January 2018. If listed, then if it is traded on that date, then the highest price on that date is the fair market value. If it is not traded on that date, then the highest price on the preceding trading date is considered. Where the capital asset, that means shares or unit, is not listed on this date, then if it is a case of unit of equity oriented fund, the NAV on this date is considered as the FMV. If the share is listed on the date of transfer, okay, it was not listed earlier but it is listed on the date of transfer, then we apply this formula to determine the FMV, and that is we multiply the cost of acquisition by a ratio, and the ratio is CII of 2017-18 divided by CII of later of 2001-02, that is the base year, or the financial year when the asset was first held. We now look at income from other sources. Dividend. Dividend under section 222E, that is deemed dividend. Now we know it is taxable in the case of advance or loan by a closely held company to a shareholder holding 10% or more equity shares. It is also taxable when there is payment to a concern, whether it be company or others, in which the shareholder has that means this shareholder holding 10% or more has a substantial interest. And what is substantial interest? Where such shareholder has 20% or more of equity shares in case of company, or 20% or more of the income in case of a non-company concern. Quantum of deduction which is allowed from the dividend income is of interest expense up to 20% of dividend income included in total income without such deduction. This is the limit. What about distribution of assets to shareholder on liquidation of a company? In case of company, no capital gain arises. In case of shareholder, there are two implications. Number one, the distribution is taxable as dividend in the hands of shareholder under section 222C to the extent of accumulated profit of the company. And number two, capital gain arises on money or assets which is received by the shareholder from the company in lieu of his shares. And for that, when we are determining full value of consideration, it is equal to what? It is equal to money which is received by the shareholder from the company plus the market value of assets received on the date of distribution, and from this what we reduce is the dividend under section 222C, because that is taxable in the hands of shareholders, so that is to be reduced while computing capital gain. Gifts, section 56(2)(x). It can be gift of money or specified movable property or land or building. In case of gift of money, the whole value is taxable if the aggregate is more than 50,000, else it is not taxable. In case of specified movable property, for example, bullion, drawing, painting, shares, securities, etc. In case of gift, that means where there is no consideration, whole FMV is taxable if the aggregate of the FMV is more than 50,000, else it is not taxable. In case of inadequate consideration, the excess is taxable. What is excess? It is aggregate FMV minus consideration. So that excess is taxable only if the excess is more than 50,000, else not taxable. In case of land or building, provided the land or building is the capital asset of the recipient, then in case of gift, stamp duty value SDV is taxable if it is more than 50,000, else it is not taxable. In case of inadequate consideration, the excess is taxable. And what is excess? SDV minus consideration. So that is the excess. So excess is taxable only if two conditions are satisfied. Number one, A, excess is more than 50,000, and B, SDV is more than 110% of consideration. If this is not satisfied, then it is not taxable. Now in case of COVID, sum may be received by the member of the family of the deceased person who died because of COVID, and the sum is received by the family member from a person who is not an employer. If the person is an employer, then it is considered under the head salaries. But where the person is not an employer, then such sum is exempt up to rupees 10 lakh, the balance is taxable. And the condition is that the death should be within 6 months of diagnosis and payment should be received within 12 months from the date of death. Now, if the property was subject to tax under section 56(2)(x) gift, in the case of the recipient, and the recipient subsequently transfers such property and computes capital gain, then the cost of acquisition while computing such capital gain will be the value taken into account under section 56(2)(x). Let's look at certain other incomes. Interest on compensation is taxable after giving a flat deduction of 50%. Interest on post office savings bank account. In case of individual account, 3,500 is exempt. In case of joint account, 7,000 is exempt. The balance is taxable. Excess share premium is also taxable. And for that, if the consideration is more than the face value, if the consideration received on account of excess share premium, is more than the face value of shares, then what is taxable is consideration minus FMV. Family pension, a deduction is allowed to the extent of lower of 1/3 or 15,000. Now, excess premium life insurance policy is not exempt under section 1010D. It is taxable under the head IFOS, and the amount taxable is sum that is received in respect of such policy minus the premiums that have been paid so far. And the premiums paid do not include any amount claimed as deduction under any other provision, for example 80C. Clubbing of income. In the case of income of a minor child, it is clubbed with the income of parent whose total income before such clubbing is greater. An exemption per child under section 1032 is rupees 1,500. Income of spouse from concern, where the spouse doesn't possess adequate qualification, then that is supposed to be clubbed. And if it is clubbed in the hands of the individual if the individual has substantial interest in a concern, that is individual plus relatives, that means individual along with his relatives, his or her relatives, has either 20% or more of equity shares where the concern is a company, or 20% or more of profit shares where the concern is not a company. Assets are transferred to the spouse or son's wife for inadequate consideration, and in that case clubbing happens in the hands of such individual. And if the assets are invested by the transferee, that is the spouse or son's wife, in the business, then clubbing is to the extent of this formula, where the business income is multiplied by a ratio, and the ratio is value of such assets which are invested, value of such assets on first day of the previous year divided by total investment on first day of the previous year. If the assets are invested by the transferee as capital contribution in the firm as a partner, then also clubbing happens in the case of interest. and the amount is interest multiplied by a ratio, and the ratio is value of such capital contribution on first day of the previous year divided by total investment as capital contribution on first day of the previous year. In case of revocable transfer of assets, also clubbing happens, but clubbing doesn't happen. There is no clubbing if the transfer is not revocable during the lifetime of the transferee. Also, clubbing doesn't happen if the transfer is made before 1st April 1961 and it is not revocable for a period more than 6 years. Set off and carry forward of losses. Loss under the head income from house property. Enter head set off limit for optional tax regime is 2 lakh. This is the limit. For default tax regime, it is not relevant because inter-head set-off of IHP loss is not allowed under the default tax regime. What are the carry forward limit of losses for different kinds of losses? Loss under the head IHP can be carried forward for 8 assessment years, speculation business 4 assessment years, a specified business referred under section 35 AD for optional tax regime, no limit. For any other business, it is 8 assessment years. Sorry. For unabsorbed depreciation, there is no limit. For STCG and LTCG, it is 8 assessment years. Loss from the activity of owning and maintaining race horses, it is 4 assessment years. Deductions from gross total income. First, we look at deduction for investments under section 80C. Maximum deduction can be 1.5 lakh and there are certain sublimits. So deduction from salary for deferred annuity for government employees is allowed up to 20% of salary. As far as tuition fees for full-time education is concerned, it is allowed up for maximum 2 children. Term deposit with bank should be for 5 years or more. Contribution to tier 1 NPS account should be for 3 years or more. Life insurance premium is deductible up to certain limits. If policy is issued on or before 31st March 2012, the deduction limit is up to 20% of sum assured. Okay, the excess is not deductible. If policy is issued during FY 2012-2013, then the limit is 10% of sum assured. If it is issued on or after 1st April 2013, if the insured is a disabled person, then the limit is 15% of sum assured. Otherwise, the limit is 10% of sum assured. There are certain lock-in periods which have been prescribed. For life insurance policy, it is 2 years. For ULIP, it is 5 years. For purchase construction of residential house property, it is 5 years. For equity shares or debentures, it is 3 years. And for senior citizen savings schemes or 5-year post office time deposit, it is 5 years. Now, if there is default and lock-in period, if there is default in complying with the lock-in period, then deemed income arises. Now, for numbers 1 to 4 above, that means in case of life insurance policy, ULIP, residential house property and equity shares or debentures, what happens is ATC deduction that was allowed for preceding previous years now becomes a deemed income. So that means ATC is basically rolled back. In case of number 5 above, that means senior citizen savings scheme or 5-year POTD, the principal withdrawn is taxable except in case of death. And as far as interest is concerned, interest withdrawn is taxable if it was not taxed earlier. ATCCC deals with the deduction on account of contribution to pension funds. Maximum deduction is 1,50,000. ATCCD contribution to NPS or Atal Pension Yojana. SSE's contribution is ATCCD 1. Now, where the SSE is an employee, deduction is up to 10% of salary. If the SSE is self-employed, not an employee, then deduction is up to 20% of gross total income. And for SSE's contribution, ATCCD 1B allows additional deduction of 50,000 rupees. As far as employers' contribution is concerned, the relevant section is ATCCD 2. If the employer is government, deduction is up to 14% of salary. Otherwise, deduction is up to 10% of salary. Now, as far as withdrawal is concerned, partial withdrawal by employee is exempt up to 25% of his contribution. And amount which is received on closure of account or on opting out is exempt up to 60%. There is an overall limit. Maximum deduction under section 80C, 80CCC and 80CCD1 cannot exceed 1,50,000. 80CCS deals with the Agniveer scheme. Deduction for own contribution is 100% and deduction for government's contribution is also 100%. Now we come to deduction for health and wellness. First is section 80D. On account of premium or expenditure on Mediclaim, CGHS and health checkup, The limit is 25,000. Additional deduction for senior citizen is given up to 25,000. Medical expenditure on senior citizen is also allowed as deduction of up to 50,000 provided mediclaim has not been paid. Overall maximum deduction is 50,000. Now 50,000 is the limit for self plus spouse plus children, and then another 50,000 is the limit for the parents. Overall maximum deduction for preventive health checkup cannot exceed 5,000 rupees. If a multi-year mediclaim has been taken, then annual deduction under section 80D is equal to amount that has been paid as premium divided by previous years during which the policy is in force. Section 80DD and 80U. 80DD is for maintenance of handicap dependent and 80U is for a disabled SSE. Disability means where the person is suffering from 40% or more of disability, and severe disability means suffering from 80% or more. Deduction for disability is a flat amount of 75,000, and for severe disability it is flat 1,25,000. 80DDB expenditure on specified diseases deduction. The formula is amount paid up to rupees 40,000. And this limit is increased to 1 lakh for a senior citizen. From this, we reduce insurance claim or the employer's reimbursement. Deduction for interest on loan. 80 is for education loan. Deduction is on account of interest paid without any limit. And the deduction is for 8 previous years, starting from the previous year when interest payment starts. 80AA is for interest on loan for residential house property. The loan should be sanctioned within this period, previous year 2019-20 to 2021-22. SDV of the property should not be more than 45 lakh. Deduction is of interest payable up to a maximum of 1.5 lakh. 80EB is for electric vehicle, and the loan should be sanctioned within previous year 2019-20 to 2022-23. Deduction is of interest payable, maximum 1.5 lakh. Deduction for donations. Section 80G for certain chief minister funds, prime minister funds, and national funds, etc. The deduction is to the extent of 100%. For Prime Minister Drought Relief Fund, deduction is 50%. For family planning expenditure and Indian Olympic Association, it is 100%. And for donation to religious place, charitable fund or institution, housing authority, etc., it is 50%. There is a limit for the deduction under numbers 3 and 4, and this cannot exceed 10% of adjusted total income. And for this adjusted total income, how do we compute? Gross total income. And from this, we reduce STCG under section 111A and LTCG. We also reduce deduction under chapter VIA except under section 80G, and we also reduce share from AOP or BOI. If cash payment is more than 2,000, then there is no deduction. 80GGA is for donation for rural development, scientific research. The deduction is to the extent of 100%, no limit, and if cash payment is more than 2,000, then no deduction is available. 80GGB and 80GGC is for donation to political parties, deduction no limit at the rate of 100%, but there is no deduction available where there is cash payment. Deduction for rent payment and for interest income. 80GG is for rent, and deduction formula is lower of 5,000 per month, or rent paid minus 10% of adjusted total income, or 25% of adjusted total income. ATI, adjusted total income. It is similar to what we discussed for section 80G. Gross total income, and from that we reduce STCG, 111A and LTCG, and also we reduce deduction under chapter VIA except under 80GG. 80TTA is for deduction on savings bank interest, and it is lower of interest or 10,000 rupees. 80TTB is for senior citizens, and not only savings bank interest but also fixed deposit interest or other interest, and the deduction is lower of interest or 50,000 rupees. Deduction for certain other incomes. 80JJAA in respect of employment of new workmen, deduction is equal to 30% of for additional employee cost incurred in the previous year. Deduction is allowed for 3 previous years from previous year in which employment is provided. Additional employee cost, AEC. This is equal to emoluments to additional employees employed during the previous year. However, if there is no employee increase in the previous year compared to the preceding year, or where the emoluments are paid by non-specified mode, for example in cash, then the AEC is equal to nil. Consequently, deduction is not allowed to that extent. Additional employees. Certain categories of employees are not categorized as additional employees. If emolument is more than 25,000 per month, the person is not an additional employee. If employed for less than 245 days in the previous year, then also not an additional employee. However, in the case of apparel, footwear or leather manufacturing business, this time period is 150 days. So if employed for less than 150 days, in such cases, then not an additional employee. ATQQB is in respect of royalty on books, and for that, gross royalty on sales which is in excess of 15% is ignored. Foreign income should be repatriated within 6 months from the end of the previous year, and that is eligible. Maximum deduction is 3 lakh. ATRRB is for royalty on patents, and just like ATQQB, foreign income which is repatriated within 6 months from end of previous year is eligible, and maximum deduction is 3 lakh. Alternate minimum tax. For this, adjusted total income should be more than 20 lakh. And how do we compute adjusted total income? This is total income computed as per the regular provisions, and to that we add deduction under section 80 JJAA, 80 QQB, 80 RRB, 10 AA and 35 AD if it has been claimed. If we are adding back deduction under 35 AD, then in lieu of that we need to reduce the depreciation under section 32. Now AMT is equal to 18.5% of the adjusted total income. To that we add surcharge and then HEC at 4%, and this 18.5% is 15% for a cooperative society. AMT becomes payable if the regular tax is less than AMT. That means AMT is the minimum tax that is required to be paid. AMT credit is eligible if the AMT which is paid is less than the regular tax which is payable. Okay, and this AMT credit can be carried forward till a period of 15 assessment years. We will now cover TDS, TCS and advance tax. First we cover deduction of tax at source, which is TDS. TDS on salary payments. Section 192, TDS on salary. What is the rate of TDS? It is a slab rate. We add surcharge and HEC at 4%. Inter-head set-off of loss under the head IHP is allowed up to a maximum of 2 lakh in case of optional tax regime while computing the amount of TDS under 192. 192 is TDS in case of EPF payments. Rate of TDS is 10% and threshold of TDS. Threshold of TDS means when is the TDS required to be deducted? What should be the threshold of the amount? It is the threshold is 50,000 or more. So where the EPF payment is 50,000 or more, then only TDS is required to be deducted. TDS on interest, dividend and investment income. Section 193, interest on securities. Rate of TDS is 10%, and what is the threshold for TDS on interest? In case of 8% savings taxable bonds 2003 or 7.75% savings taxable bonds 2018, threshold is more than 10,000. So interest should be more than 10,000 for TDS to apply. In case of debentures of widely held company, threshold is more than 5,000. In case of 6% gold bonds 1977, 7% gold bonds 1980, the total nominal value should be more than 10,000 for TDS to apply. Section 194A, interest other than interest on securities. The rate of TDS is 10%. And what is the threshold for TDS on interest? If TDS is by bank or cooperative bank or post office, in case of post office only under the notified schemes, in that case the threshold is more than 40,000. It is 50,000 for a senior citizen. And interest payment by others, the threshold is 5,000. If the interest is by a cooperative society, not being a bank, two members, or interest is on deposits, not being time deposits, TDS is leviable if its sales, gross receipts or turnover is more than 50 crore in the preceding financial year, and the interest is more than 40,000, 50,000 for senior citizens. This is the threshold for a cooperative society. If the interest is paid on MACT compensation, MACT, Motor Accidents Claim Tribunal, then the threshold is more than 50,000. Section 194, dividend. The rate of TDS is 10% and threshold for TDS in case of dividend to an individual which is paid not by cash is more than 5,000. 194K is income from units and rate of TDS is 10%, threshold for TDS is more than 5,000. 194DA is life insurance policy proceeds which are taxable. Rate of TDS is 5% and threshold for TDS is 1 lakh or more, and TDS is on what sum? It is on the sum received from which you deduct the premium paid. So it is basically the income component on which TDS is to be applied. TDS on casual income, section 194B and 194BB, that is winnings from lottery, crossword puzzles, games, etc., and winnings from horse races. Rate is 30% and threshold for TDS is more than 10,000. 194BA is TDS in case of online games. Rate is 30% and there is no threshold for TDS. However, in recent circular number 5 of 2023, it is provided that if the net winnings comprised in the amount withdrawn is not more than rupees 100 per month, then TDS may not be deducted if certain conditions are satisfied, but otherwise there is no threshold in the section as such. TDS in case of commission, section 194D, insurance commission. Rate of TDS is 10% in case of domestic company and 5% in case of others. Threshold is more than 15,000. 194G, lottery commission, rate is 5% and the threshold is more than 15,000. 194H, TDS and commission or brokerage, rate is 5% and threshold is more than 15,000. TDS in case of work and services. 194C, payment to contractors for work. Rate of TDS is 1% if payee is individual or HUF, and it is 2% in case of others. Threshold for TDS is where the sum is either more than 30,000 or the aggregate for the financial year is more than 1 lakh. No TDS is leviable for goods carriage operator payee if he owns not more than 10 goods carriages. 194J, rate of TDS in case of fees for professional services is 10% and the threshold is 30,000. In the case of fees for technical service, not being professional service, the rate is 2%. Being professional service, rate is 10% and threshold for FTS is 30,000. For director's remuneration, rate is 10%. There is no threshold. For royalty, in case of cinematographic films, rate is 2%. For other cases of royalty, the rate is 10%. And in case of royalty, the threshold is 30,000. Non-compete fees, the rate is 10% and the threshold is 30,000. The rate of TDS for call center payee is 2%. 194M is payment by individual or HUF who is not covered by 194C, 194H or 194J. In such case, the rate is 5% and threshold is more than 50 lakh. TDS in case of hire or transfer of property. 194I applies in case of rent. Rate of TDS for machinery, plant or equipment is 2%. And for land, building or furniture is 10% and threshold for TDS is more than 2.4 lakh. 194IB is rent in case of individual or HUF not covered under section 194I. Rate is 5% and threshold of rent for TDS is more than 50,000 per month. 194IA is transfer of immovable property. Rate of TDS is 1% on the hire of consideration or SDV. The threshold for TDS where the consideration or SDV are 50 lakh or more. This is the threshold. 194 LA in case of compulsory acquisition. The rate is 10% and threshold is more than 2.5 lakh. TDS in case of trade and commerce. 194Q in case of purchase of goods. The buyer is covered under 194Q if his sales, gross receipt or turnover in business is more than 10 crore in the immediately preceding financial year. TDS is on the sum for purchase of goods of value more than 50 lakh in any previous year. Rate of TDS on sum exceeding 50 lakh is 0.1%. 194R applies in case of benefit of perquisite where rate is 10% and threshold for TDS is more than 20,000 rupees. TDS in case of special cases. 194N applies in case of payment in cash. Rate of TDS depends on whether it's a case of RUI defaulter or in case of others. If the payee is a ROI defaulter, then for some more than 20 lakh and up to 1 crore, the rate is 2%. And for some more than 1 crore, the rate is 5%. In case the payee is not a ROI defaulter, then TDS in case of some more than 1 crore is 2%. Now this 1 crore is 3 crore if the payee is a cooperative society. For an ROI defaulter, he should not have filed ROI for 3 assessment years. 194P applies in the case of a specified senior citizen and the rate is the same as under 192 for salary, which is basically the slab rate, and then we had surcharge and HEC. And for 194P, the age of a specified senior citizen should be 75 years or more. TDS, some other points. 206AA prescribes a higher rate of TDS and without PAN cases, and in such case, the rate is higher of regular rate or 20%. This 20% is 5% under section 194O and 194Q. Section 206AB provides a higher rate of TDS in case of ROI non-filer cases, and the rate is higher of twice the regular rate or 5%. And as far as the relevant previous year is concerned, ROI non-filer basically has aggregate TDS or TCS deducted or collected of 50,000 rupees or more. What is the rate of TDS if both section 206AA and 206AB apply? Then the higher of both rates under both these sections is applicable. An individual or HUF is required to deduct tax under certain sections 194A, C, H, I, J and R. And he is called a specified individual or HUF, and such individual or HUF should have total sales, gross receipt or turnover in immediately preceding financial year of more than 1 crore in case of business and more than 50 lakh in case of a profession. Income gross of TDS is included in the total income, and this is actually calculated as income received multiplied by within bracket 100 divided by within bracket 100 minus rate of TDS. So if the income is received net of TDS, this needs to be converted to income gross of TDS for inclusion in total income. Certain procedures. What is the due date to pay TDS to the account of the government? For a non-government payer, when the sections are sections 194IA, 194IB or 194M, the due date is 30 days from the end of the month of deduction. And for a non-government payer, what is the due date to pay TDS in case of all other sections? When the sum is credited or paid in the month of April to February, the due date is 7 days from the end of the month of deduction. And if the amount of the sum or the income is credited or paid in March, the due date is 30th of April. Now, interest is leviable under section 2011A for TDS defaults. So for not deducting TDS, interest is leviable at the rate of 1% per month from the date TDS was deductible to the date TDS was deducted. Interest is leviable for not paying TDS after its deduction at the rate of 1.5% per month from the date it was deducted to the date it was paid. Interest is also leviable for not deducting TDS, but where the payee has paid the tax and filed the return of income. Now, here it was for not deducting TDS, and here it is for not deducting TDS, but where the payee has paid the tax instead of the payer and has filed ROI, then the rate of interest is the same as 1%, but the interest is leviable from the date it was deductible to the date the payee files the return of income. And for this purpose, for 2011A, fraction of a month is counted as 1 month and fraction of rupees 100 is ignored. Now we come to collection of tax at source, TCS. 206C1 is TCS on sale of specified goods. In case of alcoholic liquor for human consumption, TCS is at the rate of 1%. In case of tendu leaves, 5%. In case of timber, 2.5%. In case of any other forest produce, 2.5%, scrap 1%, and minerals, that is coal, lignite, iron ore, it is 1%, and there is no threshold for TCS. 206C1C is TCS in respect of lease or license, and rate is 2%, and there is no threshold. 206C1F is on sale of motor vehicle, and TCS is on receipt of sale consideration of a motor vehicle of value more than 10 lakh of rupees, and rate of TCS is 1%. 206C1G is on account of LRS remittance, that is a liberalized remittance scheme of the RBI, and also in respect of overseas tour program package. In case of LRS remittance, TCS is on the amount in excess of 7 lakh remitted by buyer in a financial year. And the rate in case of educational loan remittance is 0.5%. In case of remittance for education not being education loan, or in respect of medical treatment, it is 5%, and in any other case it is 20% from 1st October 2023 till 30th of September 2023 it was 5%. So 5% till this date and 20% on and from 1st October 2023. 206C1G in the case of overseas tour program package, the rate of TCS is 5% till 7 lakh and 20% thereafter, and this is from 1st October 2023 till 30th September 2023 it was 5% only. Threshold for TCS is nil. 206C 1H is on TCS on sale of goods, and a seller is covered under these provisions whose total sales, gross receipt or turnover in business is more than 10 crore in the immediately preceding financial year. TCS is on receipt of sale consideration of goods of value more than 50 lakh in any previous year, and rate of TCS on sale consideration exceeding 50 lakh is 0.1%. 206cc prescribes a higher rate of TCS in without PAN cases, which is higher of A, twice of the regular rate, or B, 5%. This 5% is basically 1% under section 206C1H, and the rate under 206cc cannot exceed 20%. This is the limit. 206cca provides a higher rate of TCS in case of ROI non-filer cases, and the rate is higher of twice of regular rate or 5%, and again 206cca rate cannot exceed 20%. In the 206cca, ROI non-filer basically has an aggregate TDS deducted or TCS collected in the relevant previous year of 50,000 or more. What if both 206cc and 206cc apply? Then the rate which is the higher of both the rates under these sections is applicable. An individual or HUF is required to collect TCS under section 206C1 and 206C1F, and he's called specified individual or HUF, and such person should have total sales, gross receipt or turnover in the immediately preceding financial year of more than 1 crore in case of business and more than 50 lakh in case of profession. Now we come to advance tax. Advance tax liability. Advance tax is not payable by a senior citizen who does not have PGBP income. It is also not payable by a non-senior citizen if the advance tax payable is less than 10,000 rupees. What are the installments of advance tax? Due date 15 June, installment is at least 15% of advance tax. 15 September, at least 45% of advance tax minus that which is paid earlier. 15 December, at least 75% of advance tax minus paid earlier. And 15th March, 100% of advance tax minus paid earlier. In case of SSE declaring income under section 44AD or 44ADA, presumptive income under PGBP, then 100% of advance tax needs to be paid only by 15th March. Advance tax is computed on the current income. If such income is calculated by the SSE, it is basically the estimate of current income. If it is calculated by the assessing officer, then it is basically the higher of A, total income of latest previous year for which the SSE has been assessed, or B, total income as per the return of income of any subsequent previous year, higher of these, A or B. Now advance tax which is payable, how it is computed? This is equal to tax on current income after allowing rebate under section 87A, adding surcharge and HEC. And from such tax, what we deduct is TDS deducted and TCS collected during the financial year from the income that is taken into account in computing the current income. Interest is leviable under section 234B for shortfall in payment of advance tax. And interest is payable if the advance tax paid is less than 90% of assessed tax. And interest is levied at the rate of 1% per month on the shortfall for the period starting from 1st April of the next financial year to the date of self-assessment tax payment or the date of assessment. And what is shortfall? What is shortfall? Shortfall is the assessed tax minus advance tax paid. And what is assessed tax? Assessed tax is basically you compute tax on total income. From that, what is it that you deduct? You deduct TDS deducted or TCS collected, relief under section 89 and AMT credit. For computing interest, fraction of a month is equal to 1 month and fraction of rupees 100 is ignored. Interest under section 234C is leviable for deferment of advance tax, and where the due date is of advance tax is 15 June, you need to compute the shortfall and then compute the interest. So if by the due date, the shortfall, if there is shortfall, and shortfall is what? It is 15% of tax due on return income. 15% of tax due on return income minus advance tax paid. So this is the shortfall, and the interest is 1% per month into 3 months into shortfall. Okay. And no interest is payable if advance tax paid is at least 20% of tax due on return income. If it is at least 12% of tax due on return income, then interest is not payable. For due date of 15 September, the shortfall will be 45% of tax due on return income minus advance tax paid, and interest will be 1% per month into 3 months into shortfall. And here also interest is not payable if the advance tax paid is at least 36% of tax due on return income. If due date is 15th of December, shortfall will be 75% of tax due on return income minus advance tax paid, and interest will be 1% into 3 months into shortfall. If the due date is 15th March, shortfall will be 100% of tax due on return income minus advance tax paid, and the interest will be 1% into shortfall. How do you compute tax due on return income? It is tax on total income as declared in the return of income. And from this, what do you reduce? You reduce TDS deductible or TCS collectible, relief under section 89 and AMT credit. Fraction of a month is considered as 1 month and fraction of ₹100 is ignored. We will now finally look at return of income. Return of income provisions. First, we look at regular return of income under section 139(1). Return of income is to be filed by individual, HUF, AOP, BOI or artificial juridical person if total income is more than basic exemption limit. And for this purpose, total income is to be figured out without giving capital gain exemption under section 54, 54B, 54D, 54EC and 54F, or giving chapter VIA deduction from the gross total income. So before all these exemptions and deductions, total income, if it is more than basic exemption limit, return is to be filed. Also, return is to be filed. Irrespective of this, return is also to be filed if during the previous year deposit in current account or accounts is more than ₹1 crore, or travel expenditure to foreign countries more than ₹2 lakh, or electricity expenditure is more than 1 lakh, or sales turnover or gross receipt in business is more than 60 lakh, or gross receipt in profession is more than 10 lakh, or TDS deducted plus TCS collected in his case is 25,000 or more. This amount is 50,000 for a senior citizen. Or deposit in saving bank account or accounts is 50 lakh or more. Now, what is the due date to furnish return of income under section 139(1)? In case the person is required to furnish a TP report, and in case such person is a firm, then even the partners of such firm, the due date is 30th of November. Further, in case of a company or in case where tax audit is required, plus in case of a firm, for the partners also of such firm, the due date is 31st of October, and for all others, the due date is 31st of July. Belated return or a revised return. In such case, the due date is the earlier of 31st of December or the date of completion of assessment. Updated return. The time limit is 24 months from the end of the relevant assessment year. In case of a defective return, 15 days is the time which is allowed to rectify the defect. We now look at PAN and Aadhaar provisions. Now one needs to apply for PAN. If the total income during the financial year is more than the basic exemption limit, apply by 31st May of the assessment year. If the sales turnover gross receipt of business or profession in the financial year is more than 5 lakh, apply before the end of the financial year. In case of financial transaction by a resident non-individual in a financial year is 2.5 lakh or more, apply by 31st May next of financial year. That means following the end of the financial year. In case of cash deposit or deposits in a financial year in a bank or post office, if that is 20 lakh or more, then apply within 7 days before. In case of cash withdrawal or withdrawals in a financial year in a bank or post office, if that is 20 lakh or more, apply within 7 days before. In case of opening current account or cash credit account in a bank or post office, apply 7 days before. Now, in case of certain transactions, PAN is required to be quoted. If you buy or sell a motor vehicle not being a two-wheeler, or you open a bank account not being a time deposit or a savings bank account, or you apply for a credit card or debit card or open a demat account, then you need to apply. Then you need to quote the PAN in the relevant documents. If you pay for a hotel, if you pay for a restaurant at any one time, or you pay for foreign travel or pay for foreign currency at any one time, then PAN is to be quoted if the if the amount is more than 50,000 in cash. If you buy mutual fund units or debentures or bonds or RBI bonds, then you quote PAN if the amount is more than 50,000 rupees. If you make a deposit with a bank or post office or you buy bank draft or pay order or banker's check from a bank, then you need to quote PAN if it is more than 50,000 cash on any one day. Okay. If you're opening a time deposit with a bank or post office or a Nidhi or NBFC, then you need to quote PAN if the amount is more than 50,000 or it is more than 5 lakh in the financial year. If you pay for prepaid payment instruments, then you need to quote PAN if it is more than 50,000 in the financial year. If you pay life insurance premium, quote PAN if it is more than 50,000 in financial year. If you buy or sell securities not being shares or unlisted shares, then you quote PAN if it is more than 1 lakh per transaction. If you buy or sell immovable property, you need to quote PAN if the amount or the stamp duty value is more than 10 lakh. If you buy or sell any other goods or services, you need to quote PAN if the amount is more than 2 lakh per transaction. Now, the provisions regarding intimation of Aadhaar to the tax authorities. The due date to intimate Aadhaar to the tax authority was 31st of March 2022. Fees will apply under section 234H upon late intimation. That means if Aadhaar is intimated after this date, then if it is intimated within 3 months from 31st March 2022, fees will be 5,000 rupees. If beyond 3 months, fees will be 1,000 rupees. And the PAN will become inoperative from 1st July 2023. And negative consequences will follow, specified negative consequences till the date PAN becomes operative, and PAN will become operative within 30 days from the date of Aadhaar intimation. Now we look at certain other provisions. Interest under section 234A is leviable in case of default in furnishing of return of income. Interest is at the rate of 1% per month on the shortfall from the date following the ROI due date to the date of filing ROI or the date of assessment in case no ROI is filed. Now, what is shortfall? For this, you compute tax on total income and then you deduct what? You deduct advance tax paid, TDS deducted, TCS collected, relief under section 89 and AMT credit. And that means the shortfall in which interest is computed. Fraction of a month is equal to 1 month and fraction of rupees 100 is ignored. Fees under section 234F is leviable for late filing of return. Where the total income is not more than 5 lakh, fees is 1,000 rupees. Where the total income is more than 5 lakh rupees, fees is 5,000 rupees. Self-assessment tax need to be paid as per section 140A. And how do you compute self-assessment tax? You find out tax as per the return of income. From that, you deduct what? You deduct advance tax paid, TDS deducted, TCS collected, relief under section 89 and AMT credit. And then you add what? You add interest under section 234A, B, C and fees under section 234F. Now, if the self-assessment tax is actually paid of an amount which is less than what is required, then the order of adjustment, then the amount that one pays will be adjusted first against fees, then against interest, and then against tax. Updated return. When updated return is filed, one needs to pay additional tax. One needs to pay tax. And there are two situations. If the updated return is the first return, that means no earlier return has been filed for the same assessment year. In that case, how do you compute tax to be paid while filing updated return? So tax on total income as per updated return, and then you deduct. You deduct what? Advance tax paid, TDS deducted or TCS collected, relief under section 89 and AMT credit. And then you add what? You add interest under section 234 ABC and you add fees under section 234F and additional income tax. Additional income tax. In a situation, if updated return is not the first return, you have filed a return and now you are updating that return, then how do you compute the tax? You compute tax on total income as per updated return. Then what do you deduct? You deduct tax or the relief for which credit was taken at the time of self-assessment earlier. Then you also deduct TDS deducted or TCS collected on additional income and AMT credit which was not claimed earlier. After this you add what? You add interest under section 234BC, not under 234A, under 234B and 234C. Less if any interest was paid earlier. And finally you add additional income tax. Now we come to additional income tax. Additional income tax, we'll see what is additional income tax. If the updated return is furnished within 12 months from the end of assessment year, additional income tax is equal to 25% of tax plus interest. 25% of tax plus interest. If the updated return is furnished after 12 months from the end of the assessment year, the additional income tax is equal to 50% of tax plus interest. So this was the super fast revision of all the useful and important facts and figures, formulas, dates, thresholds, limits, etc., etc. So this you will find extremely useful, and as I said before also, revise this, go through this video, revise this compiler on and off, on and off, on and off every fortnight, closer to the exams, make it more frequent every week or maybe every 2 or 3 days, and this will ensure that all the facts and figures are properly ingrained into your mind, fixed into your mind, so that you will not make any error or omission when you start to solve questions given in the exam paper. So all the very best to you. Good luck to you. If you have any comment, suggestions, or any query, questions, etc., feel free to write to me in the comment box. I will reply to you as soon as possible. Best of luck to you. Goodbye and see you soon in my next video. Good luck.